standing upside down. So we would have here, this would be, oh my goodness, I just turned myself around. Who cares? Right shoulder, head, left shoulder. You take your pick. The right or the left just doesn't matter, folks. Okay, so this could be right, this could be the head, and then that could be the left. In any case, it simply describes the way the pattern is formed, the way it looks. There's the shoulder, there's the head, and here's the other shoulder. I point this out because we could be looking at a bottoming formation in the British pound. What I tend to look at more is this. You have an area where the market found some support. The market pushes through that support but cannot follow through, and now is in the process of retesting. That's really what the head and shoulders pattern is describing to us. Again, we have the market making a support area. The market pushes through that support area but cannot follow through and is now retesting that support area. So I don't feel comfortable. In other words, there aren't any very low risk opportunities really anywhere inside of this rectangle. And just to give you an idea, the top end is 9499 and the bottom is 9365. So from 9500 down to 9365, let me go ahead and write that out. From 1.9500 down to 1.9365, we've got to be careful. Okay, this is where the market is digging in. It's getting support. So what does it mean when the market gets support? Remember, the key to this is understanding why the market is doing something. Remember the whole insider code. Yes, there really is an insider code. What you can expect when the market gets into an area like this, and this is why black boxes don't work all the time, this is why trading systems don't work all the time, because as the market is getting into this bottoming process, you'll find the market making very fast moves to the downside like this, where over the period of 3 or 4 hours you get a sharp move down. It happened here, here, so boom, 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 3 pushes down, and the market just whips right back up. So you get these V bottoms. Remember when we've talked about V bottoms? V, V. Okay, so the market just repeatedly makes these V bottoms. Because of that, you don't get much follow through. So if you are going to sell in this area, if you're going to trade from the short side, you've got to be ready for this. This is where the 80-20 rule came from. Some people ask, well, why do you take off 80%? Why not leave some on? Well, it's because the 80-20 rule works very well inside of these types of markets where I don't expect a lot of follow through. I can let the market break through this low, for example, right in here. So if we were looking for a short trade, it would be from 94.51 down to 94.44. So 94.51 down to 94.44. That's 1.9451, 1.9444. If I'm looking to sell in this area, then I need to make sure that I'm taking off 80% very quickly. Remember, that's after a 20 to 23 pip move, and then I let the rest of it ride. Why am I letting the rest of it ride? Well, if the market does manage to follow through, I want to capture the larger move, but then I don't want to take on a lot of risk, so I move the stop to break even. So I would take profits on 80%, and then the stop would move to my entry price, whatever that might be. So there are a couple of areas for the upcoming trading. We'll have to wait and see how the London session comes about, and also New York.